Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Steve Hyland, also known as Small Cap Steve and known from the Deep Dive. How you doing today, Steve?
I'm doing great, Daryl. Thanks a lot for having me on. I'm really excited to be doing this.
Yes. And first, starting off, I just want to encourage the audience to go check out your keynote speech at the Vancouver Resource Investment Conference. And I really love how you related it to the baseball and such. And it was very broken down very simply for people to understand, okay, what are they getting involved in when they are investing in these companies? And so what was kind of obviously you have a background in teaching and such. So as a teacher, as an educator, you have to be able to break things down for whatever your age level your audience is or whatnot. Just curious in your thoughts behind developing that keynote speech and what you wanted to, what objectives you were trying to achieve with that.
I appreciate the kind words, and I think that the idea, and it wasn't just myself who wrote that. I worked with my partner, Jay, and we put a lot of work into that, actually. And the idea was anybody can go up and get on a podium and talk about how governments, they do too much deficit spending, they print too much money, and gold and silver are going to the moon. We can talk about the inventories at the COMEX and how silver is going to skyrocket, and that tends to get a lot of views on YouTube. But there's not really a whole lot of practical value for anybody who's watching a keynote like that, because there's a million channels that just basically make a living off of putting the words that people want to hear out of the speaker's mouth. So we thought about it from the perspective, and I'm a former high school math teacher, and I'm always just trying to learn. That's one thing that I love doing, whether, at nighttime if I'm on Duolingo trying to learn Spanish, or I started playing piano on Rocksmith, which is a phenomenal game to learn how to play an instrument. Just whatever the tool may be, it's just something that I take a lot of value in. And so if I step back a little bit, we started really digging into mining just maybe 3 or 4 years ago. Originally, the Deep Dive launched, we were primarily focused in cannabis stocks, which that's where the audience was at the time. There were Facebook groups with over 20,000 Facebook members that were talking about the stock market, which was really fun. But the odd thing about it that both myself and Jay found at the time is that you'd go in these Facebook groups and there'd be guys saying, I'm going to have an AMA on cannabis stocks, ask me anything. And we noticed that a lot of the people that were going on there and speaking they didn't actually know anything about anything. They were just basically talking about price to sales multiples, that if anybody had any basic accounting knowledge, they could tell, well, these are kind of silly. One of the classic examples was Afria, which was one of the big cannabis companies, and they went out and bought a pharmaceutical store distributor. So they were selling, toilet paper and tampons, and they were able to acquire this company that was doing, I don't remember the exact number, but it was in the tens of millions, if not hundreds of millions of dollars in revenue, at a multiple that nobody in the private equity world or the actual business valuation world would value a company like that at. But they were trying to get the cannabis multiple on that business, which that's existed throughout stock market history. You go back to the .com era, companies were buying distribution companies because they know that in bubbles, a lot of investors, they like price to sales multiples because it's something that they can make sense of, and you can kind of fool them into thinking that the two things are equal. So anyways, we noticed that there was a huge trend in that. We started covering it. We started writing about it. And at the time, I was actually a math teacher. And I was chatting with a company that was called MedMen. I don't know if you remember MedMen. They famously did a video, a commercial that was directed by Spike Lee, and then South Park did a whole take on it. That was supposed to be the next evolution of cannabis stocks, where Canaccord really backed them heavy, and they were going to be the canopy growth of the U.S. And they went and they got a store in Times Square, and they raised hundreds of millions of dollars, if not billions, and that was supposed to be the big thing. Now, the reason that all the companies were coming to Canada to list on the Canadian Stock Exchange was because of something called Regulation S, which was this sort of weird regulatory gimmick that the fancy lawyers in Canada came up with that said, you know what? Because cannabis is a Schedule I drug, you'll never be allowed to have a primary listing in the U.S. Mm-hmm. The TSX and the TSXV, they didn't want to touch that. But the CSE and the lawyers in Canada seem to say, okay, well, if you have a foreign direct issuer status, then you know what? We're fine with it. So what they did was they created a multi-voting share structure. There wasn't really a typical multi-voting share structure. It was just there to suppress the percentage of ownership that could convert later down the road, so that they could say that the primary shareholder base isn't in the U.S., it's outside of the U.S., and that way, well, it's actually a Canadian listed company, so we're going to allow it to be listed on the CSE. So at the time, there was a whole bunch of letter writers who were pissed off at MedMen because, as you know, probably from having worked in this industry for a few years, there's a whole bunch of these letter writers that go out there and they ask companies for money for advertising fees. And MedMen, foolishly at the time, was saying no to pretty much all of them. And I think that was much to their detriment, given how cannabis stocks actually worked. And then a whole bunch of them started crapping all over the company. So I was investing in cannabis stocks at the time because that's where the capital was, and there was a lot of money to be made there. And I was chatting with the company directly, and I was just, asking them some basic questions. And then I started explaining to them how the multi-share structure worked, which at the time the newsletter writers were all just being like, oh, all these US companies, MedMen's the worst, they're a big scam because of the multi-voting share structure, you guys haven't read the fine print. And it's like, had they have just like had a normal cap table with the same multi-voting shares at their percentage base baked into the cap table, nobody would have said anything. But it was just those words that the newsletter writers largely didn't even understand that they used to dig into the company. So I was explaining that to MedMen, and the director of communications at the time said, Steve, you really understand this stuff well. You can explain this to us better than we can explain it to our own shareholders. Why don't we hire you? Now, at the time, I didn't work for MedMen, but I sort of looked at the space and I said, okay, I can probably help some companies with their investor communications. And as an investor at the time, it seemed like if I'm going to invest in a stock, it's not a bad idea to try to help them out because so many of these companies are lost. And then that kind of like led to the deep dive starting. And then probably about 3 years later, around, we'll say during 2019, 2020, when everything kind of flipped up on its head, I sort of said, okay, well, now's the time that we got to really educate ourselves about resource investing. And I'm sure that this is something that you're going to be able to appreciate, is that it's the worst way. There couldn't be a worse way to learn about resource stocks than talking to CEOs and geologists of publicly traded companies, because basically every project that isn't theirs is crap, and whatever their project does have, they're going to tell you about the good stuff, the upside. They're not going to tell you about any of the downside risk or the problems with the project. So we probably spun our wheels for a couple of years trying to learn the space, trying to figure out what all this stuff meant. What's the difference between a deposit, a resource, and a reserve, and just all these little things that like are never properly articulated to anybody. And that kind of just all that experience led to us to a place where when we got to the VRIC keynote, how can we take what we've learned and just systematically make it make sense for people so that they understand. These companies are all at different stages. They all present information very differently, and their entire goal is to just try to confuse you into thinking that their company is worth more than it is. So we tried to put together a criteria where we break companies into various categories based on who they are, like project generators, royalty companies, developers, production companies, companies that have hit some pretty significant drill holes that are doing significant amounts of drilling, companies that have done some level of drilling, companies that are basically moose pasture, as we call them. And let's try to break those into category, and then that way we can actually maybe look at them by region and try to make sense of where there's value. So the whole goal was to just maybe try to look at it like, hey, I'm talking to like a grade 11 or grade 12 high school student, and how can I teach this to them in a way that they can actually have some sort of bearings to make sense of the entire space of how do I start and how do I make sense of everything. And that, and to me, for most of these companies, like if you talk to somebody who's really good at investing in the space and you bring up a company, they can effectively take a stock and turn it into the back of a baseball card. Like, what assets do they own? How much drilling's happened in the past? If they're doing production, how much are they producing? What does their ASIC look like? How much cash flow are they generating? If they've done some drilling, what do those drill holes look like? And what does that mean relative to the entire field? So if we turn them into the back of the baseball card and we can just look at those really high level details that actually describe the value that a company has, then we have a way to actually look at relative valuation, which relative valuation 3 years ago was a fool's errand because there wasn't enough capital in the space. But now that we're actually starting to see life come into the space, and we're going to start to see Facebook groups with 20,000 people investing in mining stocks, that's my belief that that's where we're heading. That's where relative valuation is going to really start to matter. And that was the whole premise of the keynote.
Yeah. I appreciate you giving that context too. So earlier you mentioned that anyone can start a channel, talk about like the government debt, deficits, all of that, which all that stuff's important, right? And one thing that Rick Rule taught me, and I think this was in 2023, it was my first time at his symposium, and I interviewed him. And I love talking macro. I love macroeconomics, right? And I would always talk to Rick about macro, and then Rick, he told me, he said, "Hey, Daryl, it's good to know the macro, but the money's made in the micro." And that always stuck with me, right? And it stuck with me because it was like, okay, I need to get to know what, outside of being a stacker, at that time I was a stacker, and I would invest in like, the VRICs or the Newmonts, the tier one companies that, and, because it was just less risk and I felt like I didn't have to do as much due diligence. But then I had to like engage with these exploration companies, engage with the royalty companies, the smaller royalty companies or the developers and such. And so that was kind of like my introduction to this particular sector, because it seems like everything's important. And for me, like my typical approach is, okay, who's the CEO? What success do they have in the past? Does the company have access to capital? Are there credible investors that are buying some of the shares? And sometimes there's some solid companies that you may find that don't necessarily have big capital behind them or whatnot. And so that's something to keep in mind. But, everything matters. And then when you get down to the project, what is the project to all of those things of like the drill, what are the drill results, or what, are they permitted yet? All those different things, everything matters. So I'm curious what's kind of like, so you have a criteria. So if you're able to put this on the back of like a baseball card, what are the top things you're looking at? So like, let's say you're at a conference, you run into a company for the first time. Obviously, let's start with exploration company. Let's say you run into a gold exploration company. What are the biggest things that you're looking for, like let's say in the first 10 minutes of that conversation? What do you want to know about that company?
I'm glad you asked that, because we often have calls. Like a lot of the stuff that I do is on our YouTube channel, where it's just me interviewing these CEOs. But there's always like and I'll admit this, there's always a bit of I'm being polite. We're putting this out in the public domain, so I'm not gonna just absolutely grill you, because as much as people like to pretend it, you're gonna have a hard time getting people on your channel if you just go and cut their knees off every time. Yeah. But one of the questions that I always ask is I'll listen to somebody talk about their project for like 20 minutes on, like, if they're just pitching me on a Zoom call or in person or something. And one of the first things I like to ask is how much drilling has happened on this project, because there's a lot of stocks out there that have close to no market cap, where there is a whole boatload of historic drilling in it. And to me, I'm very fascinated by that, because if there's a lot of drilling that's happened in the past, that means that at one point somebody thought that this project was interesting enough that they were able to go and raise tremendous amounts of money to do drilling. Like, you think about, like, some of these stocks that I can point to that have sub $15 million market caps have a couple 100,000 meters of drilling. And like that's like a couple $100 million of money into the ground that has been completely forgotten about. So that's usually like an okay first step, is how much drilling has happened here. Are we talking about something that is completely grassroots, or are we talking about something that people have spent a bit of time on? And something I learned from talking to some of the smartest investors that I know in the space is they often say that they want to invest in things that have been drilled like Swiss cheese, because they're often de-risked and the geologists know what they're playing with. Now, look, sometimes there's a whole bunch of drilling that happens, and they walk away from it because, okay, well, this just doesn't make sense. And sometimes you're just in a bull market where there's a good story and something gets drilled like Swiss cheese. One example I can point to is Newfound Gold, who I think has spent something like, and I shouldn't just be throwing out numbers, but in the hundreds of millions of dollars drilling out that project. And it's highly debatable if there's anything that's actually economically feasible there, because it's just the resources scattered amongst so many small deposits that it's like, I don't know that this actually makes sense. So there are cases like that exist out there. And then and then there's also like a little bit of an argument too, not to get too far off topic, but as the price of gold continues to skyrocket, and I was having this conversation with Don Durrett last week, where he says he doesn't like gold projects with small deposits. But I mean, as gold starts to go to $5,000, $6,000, $7,000, 100,000 ounces of gold in the ground, if it's high grade, that's got to be pretty interesting. I would have to imagine, because we're now talking about billions of dollars of gold in the ground. So one of the first things I like to ask is how much drilling has happened, and if there has been a bunch, what do those grades look like? And then that kind of helps me start to form that back of the baseball card look that I need to know, okay, I now have some comps that I can compare them to that give me a sense of really sort of what I'm playing with.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Looking at how much drilling has happened on the project, so sometimes these projects are, they've been explored by some companies, and then someone buys them out, or someone bought it a few years ago and such, and they have like this history of drilling happening, or let's say VRIC used to own the project or whatnot. Are you factoring in like those historic drill kind of drilling results, and what is the company currently doing? Are you factoring in both of those? All of it?
Absolutely. Absolutely. Because if I would assume that in most cases, and it's always something that you want to ask management teams, is do they have access to that data? And that is something that is like, that's, look, it might not be 43101 or JORC compliant, but they have that data that tells them where they want to drill. And so much of this space, when we're talking about the actual exploration and discovery game, is just being able to rally the street around your name, because it is so dilutive to actually go and prove something out that you have to get the street to back you. So if they have a whole bunch of historic data and they're starting out with not that much money, you would like to think that they should know where they can drill to at least go and get some 43101 compliant drill holes that are going to excite the market a bit. And obviously you want to be careful of companies who, go and raise like $1 million and twin a hole, and like, okay, well, we can use Google or newspapers.com and go and figure out that hole was already drilled. But if if they have the data, they can probably go out and do what they need to do, and they have the knowledge base that they need to at least go and get this thing started, to be able to go and start to rally the street around them, so that when they go to raise that money that they need to prove it out, they can keep doing it at higher levels by just generally rallying the street around them.
Mm-hmm. Got it. So how much importance do you put on access to capital? So, I mean, obviously, shareholder dilution is a big problem in this industry, and there's going to be dilution. Like, you know, even some of the best of the best companies have issued more shares, right? But there's a difference when you have, someone like Bob Quartermain, who's over at Dakota Gold, who has huge amounts of access to capital, has huge success in the past, or, the Inventor Capitals, the Endeavor Financials, and some, Fiore groups, right, who have huge amounts of capital to help fund some of these initiatives. And so curious in your thoughts on how important is that?
That is probably one of the most challenging questions to what I'm proposing that there is, Daryl, and you kind of hit the nail on the head there, because you might look at one company that is tremendously undervalued, because I'm talking about something here that the market has completely forgotten about. So they don't have a Frank Schuster behind them, or a Craig Perry, or a Brad Langell, or we can go through a whole list of these guys that have this access to capital. But the problem with the companies that do have the access to capital is that they're usually appropriately valued. So at that point, it's a little bit more challenging to actually figure out, okay, do I like the upside here relative to this valuation to actually call it a no-brainer? So my process, which if you talk to a lot of the top guys in the space, they will tell you that it's kind of a foolish bet. But I like to bet that in a bull market, that access to capital is going to appear in a bunch of these names, and that's where you're going to see a re-rate. Now, that doesn't always happen, because I've been in names where the CEO does something like goes and sells the property for nothing, and that there's a side deal that happened, but you don't have enough money invested to go and create a class action lawsuit or anything. Like, what are you going to do? You just kind of lost on that bet, and that can happen. So the one thing I'd say is you don't want to put too many eggs in one basket when it comes to playing this strategy, but it's 100% the reason that a lot of these companies that I'm proposing are significantly undervalued is because they don't have that access to capital. And the bet is that in a raging bull market, that access to capital is going to appear as we see those Facebook groups with 20,000 people, mm-hmm. and the generalists start to pour in, who are just doing what I'm proposing, looking at the back of the baseball card and saying, hey, this company here has a 2 million ounce resource, it's permitted, and they're trading at a $30 million market cap. And in my keynote, I mentioned a couple of those names. One of those was 1911 Gold, who Sean Heinrich, I met with him like a year and a half ago. And I looked at his stock and I said, wow, I can find a comparable that is like as close to apples as you're going to get. They're trading at a $300 million market cap, and he's trading at like a $15 million market cap. Mm-hmm. And for some reason, I didn't pull the trigger, because I was sort of like, okay, well, there must be something wrong here. What am I missing? And that stock re-rated, I think it was a 10x, mm-hmm. 7 months after I had that first conversation with Sean. Now, in that case, Sean has a very, very strong background. He's somebody you talk to, and you just get the sense that he is going to be a strong custodian of capital. So the bet on him as somebody who would find that capital or would be able to access capital was probably a pretty smart, educated guess, which I look at and I regret not making that bet. But I think that those are the names that are the ones where you're going to find the most value in a market like the one we're in right now.
Okay. So it all comes down to, I mean, obviously risk reward. So you have an appetite for alpha investing, and may have higher risk, but it has huge upside potential and rewards. And you're eliminating a lot of that risk by, doing further due diligence and understanding the project, understanding the drill results, and so on and so forth. So whenever, I'm curious in your thoughts on, obviously, when you have a company that does have access to capital that has already been, I guess, appropriately valued, I'm curious in your thoughts on the developers. And so, obviously they're not at the point where they are producing the metal out of the ground. So I'm invested in a few developers that are scheduled to go online in the next, 2 to 3 years and such, and start actually producing gold or silver out of the ground. And so I'm curious in your thoughts there. So obviously you have the Lassonde curve where, you get a big bump, on the exploration side of things, and it gets sold and permitted and all of that, right? So what's your thoughts on the developers? They're kind of like in this interesting stage before they start producing the gold, but they're already past like the exploration hype. So curious in your thoughts there.
I love the developers, but there's a bit of survivorship bias that goes on there. Like we can look at Lundin Mining, who I highlighted in my presentation, did phenomenally well from the point that they kind of hit that Lassonde lull, as I call it, that point where you're kind of in between that discovery and production phase where investors are like, it's going to be a long wait. That's a patience game, and it's one that can work out phenomenally well. But there's also a bit of survivorship bias there. And what I mean by that is that we like to highlight these names that sort of go from ramping up production to hitting it, and investors, another one's Artemis Gold in the Blackwater project in BC, that it did phenomenally well as they went from that Lassonde lull to production. But then there's a whole bunch of names out there that you can bet on that end up screwing it up. And one example I highlighted was Pure Gold, who they saddled themselves with too much debt, and then they ultimately found themselves going into receivership, and now they are West Red Lake Gold. So phenomenal opportunities exist in that sort of developer phase. And I think that one of the challenges that happen with a lot of retail investors is that they're so like short-sighted, right? Like a lot of them, they want to invest in things that are going to go up like 1,000% in the next like month, or at least start to go up. And you don't know that, right? Like picking the timing on these things is incredibly challenging. Permitting is not like always a straightforward thing. I mean, I've got some companies that I chat with regularly that have some of the biggest mining projects in Canada, and the feedback that they give me from dealing with the Canadian government is that sometimes they wait months and months and months and months and months to get feedback on something that should have only taken a few days. And that's really a patience game. And I think that there is tremendous opportunity there. The one thing that I would just encourage anybody who's in the audience watching this right now that wants to play that patience game is really be aware of the capital structure the company's creating and just the amount of debt they're taking on. Because if we learned anything from Pure Gold, it's that, okay, if you take on too much debt and then, you end up not going and extracting the right ore, or things don't go to plan, which they almost never do, there's a chance that you're going to find yourself in a position where you just run out of cash runway, and then it ends up in the hands of somebody like Frank Giustra, who's kind of become a bit of he's sort of turned into the king of the restarts. He's purchased a whole bunch of them, which, like, if you knew mining and you had his kind of access to capital, is exactly what you should be doing. You find stuff where other people have spent, hundreds of millions, if not billions of dollars building out a project, and then they just ran out of money, and then you can go pick it up for a song, a few $1,000,000, and suddenly you get to restart the whole thing. I think that's been a pretty good strategy of his. So the only thing I'd say is, if you're going to play that strategy, just be aware of the level of debt the companies are taking on.
Yeah, for sure. I mean, that's pretty savvy, you know, to be able to get that, and then, you know, in addition to like his access to capital, like his access to like the top quality knowledge and experience in the sector too. You know, where it's like,
he's done it with a whole bunch of names. Their most recent one is Ascot, Selkirk Copper, West Red Lake. Those are the three that are coming to the top of my head, but I'm sure that there's other ones too. But those are just sort of recent names that he's sort of done that with, and like I think that's absolutely brilliant. I forget how much they paid. Like Pure Gold, I think at one point had like an $800 million market cap, and they paid like less than $5 million for that in bankruptcy court. And then they put out a news release. I don't think that the former Pure Gold guys appreciated this too much, but they said that they just found like a few $1 million of gold just sitting in the equipment after they took it over. It almost paid for their purchase.
Yeah, for sure. Yeah, definitely. So when you're so obviously you're more focused on small caps. So is there a limit to like the smallest market cap you're willing to engage with, or like what does that look like? What range? I mean, obviously, so I bring this up because you mentioned it earlier, and then offline we were talking about. I'm friends with Jeff Phillips, and so Jeff Phillips, he typically finds these companies at, you know, $10 million market caps, 15 million, 30 million, and he pulls in capital and then the companies eventually end up growing to like, you know, 100 million, 200 million or whatnot. And some of those companies, I mean, he's been behind Empress Royalty, early stage, you know, and many others early stage and such. And so, what's kind of like do you have like a minimum market cap that you're willing to engage?
Well, at this stage, I don't. I'm more interested in what they just look. I'm not a geologist, right? So I can't sit around and like look at drill core and tell you what's in it. I am learning tremendously. I now have the luxury of getting to go on site visits, and sometimes you're there with an angry investor who's like spotting out a million problems that you wouldn't have previously recognized. But now the next time you go out, you're watching for those things. But in terms of the screening process, I mean, there's things that just get forgotten about that have tremendous value. And I think that to Jeff's credit, that's an absolutely great way of playing it. But the tough part with a lot of these management teams is that you really need to be in a position where you actually can call the shots. And there's supposed to be a rule in capital markets that he who raises the money makes the rules, and that's how it should be. If a CEO is just, you know, spinning his tires for 10 years, and then somebody comes along and he raises a whole bunch of money, then he should have a fair bit of say over what's happening, because that CEO wasn't able to go and do it himself. This guy has the network, and he has the access to capital, or she, and they have the ability to go and turn this whole thing around. But I think that one of the challenges is that you need to be in a position where you actually are bringing enough money to the company to really just make sure that the CEO isn't doing dumb stuff. And that is a problem with the space. I mean, a lot of these guys, like, they like fancy dinners. They like to go to conferences, and then you see them at conferences, and it's like they're not taking meetings, but they're drinking expensive wine, and they're going to nice restaurants. Maybe they bring their wife with them, and she's hanging out at the pool at the Boca. The Rule Symposium's pretty good, though. You don't see a lot of those types of companies there. Yeah. But I have been to some conferences where you'll see a company bring like it's like a little, like, you know, $8 million market cap company, and they bring a team of 5 or 6, and they're all bringing their wives with them to like Miami or something like that. And it's just like, guys, this trip probably cost your group like $60,000, and nobody seems to be taking it that seriously. So to answer your question, if you are investing in those small names and you have Jeff's ability, then I would imagine that when Jeff does this, he's putting a whole bunch of terms and conditions on that money that, like, he's going to have a bit of a say over how things at that company are being ran, and that they're being ran properly. But some of these companies you do have to be careful with, because if they got a $5 million market cap and a tremendous asset, you're obviously playing with a bit of fire, because you don't know exactly how that money is going to be spent if they go and raise it. So I'll look at anything. I'll look at something that's got like a $2 billion market cap, something that's got like a $2.5 million market cap. It doesn't really matter to me, but I'm certainly going to have a bunch of conversations with management and try to suss out how I feel about their ability to actually deploy capital.
Okay, so G&A costs. So obviously, royalty and streaming companies, they have a lot less G&A costs than a exploration company or a mining company and such typically, right? So what are you looking at there? So obviously, I mean, you mentioned a few things, like if CEOs out, bringing their wives and everything, and it's the housewives of the miners or whatever, they're having a reality TV show, and they're doing all this on the investor's dollar, right? So that's a problem. So typically, what are you looking at with G&A costs with some of these smaller companies?
Well, typically you want to see it be as small as possible. So you don't want to see a company go and raise $1 million in a year and then $800,000 of that go to G&A. You want to see it spent in the ground. That's obviously something that you want to see. But one of the challenges that I have with this, Daryl, is that you can hide stuff in accounting really easily, right? Like there's lots of line items that you can use to maybe try to deflect where the actual dollars are being spent. And sometimes companies will do things like just call things prepaid expenses when prepaid just means that they already paid it. In the mining world, it might as well just be expensed. So that's one area when you're looking at those tinier companies that you probably want to look at is those prepaid expenses, because I've seen some pretty bizarre situations over the years, like a company with a $5 million market cap that has like $3 million in prepaid expenses. It's like, okay, well, they raised a bunch of money and they just gave that back to a bunch of consultants, and based on how the stock's trading and the actual corporate development of the company, they're not getting a whole lot for that.
Wow. Yeah. That's true. So at VRIC back in January, I was talking backstage with Randy Smallwood, and he stepped down as CEO of Wheaton. Obviously, Wheaton's a huge company, $60 billion market cap. But in talking with Randy, he was saying investors should have a kind of like a baseline foundation of tier one companies, like whether that be a Wheaton, a Franco, or a Nico Eagle, and such, and then invest in some of the more high alpha companies on top of that baseline layer. Curious in your thoughts on that strategy, and if that's something that you subscribe to.
I do. I think that if you're a true bull on the space, capital tends to move down the risk curve as we enter further and further along the bull cycle, and that's in large part. And I was having a great conversation with the CEO of Collective Mining, Ari. I forget his last name. It's Ari Sussman. And this was like a year ago, and I remember him saying to me that because we were just talking about the issues with the Canadian retail space, how and I apologize because I know you're from originally Oklahoma, you're now based out on the West Coast, so you're probably not as familiar with what sort of happened in the stock market in Canada over the last 2 decades. But I think that it's important to understand that, so that we kind of understand where we've come from in the mining world to where we're going. And that is that years ago, people used to have stockbrokers who would call them and they'd tell them to buy stocks. And then at some point, discount brokerages became a thing where people started getting, $10, $30 trades at TD Waterhouse or TD Bank or, E-Trade or wherever. And so then they no longer needed stockbrokers, and now we even filtered all the way down to what do we call them, the robo advisors, where in Canada, we have, I forget the name of them, but like the Robin Hoods and the, what's the other one? Bull Trade or something, I forget.
Yeah, Webull.
Webull, yeah.
Moomoo.
Yeah. So what that's done is it's actually made it so that the people who have the money now in Canada, they're now using sort of wealth management style investment advisors who they're not going to put them in anything that's like a sub $5 billion market cap. Like that's just not in their criteria. They don't touch that. So the junior mining world really got impacted by that. So now the entire space depends on retail investors. And a lot of times you see these big financings, it's actually hedge funds who are doing it, and they're just going to scalp it. And it's retail investors who are the lifeblood of the sector. And there hasn't been that much of that. It's gotten a lot better over the last year. But the conversation that I had with Ari about this is sort of, okay, well, when are we going to start to see a bunch of these juniors explode? And his response was, we are going to see a bunch of these majors start to get taken out, and then that's going to free up cash, and that's going to move along the risk curve. And then eventually, as that happens, you're going to see retail investors take note, and that's when it's going to take off. So quite frankly, if somebody were calling me and they were saying, where should they be placing money in the space right now? And I'm not a licensed financial advisor. My answer would be the companies you just named. I love Agnico Eagle. The royalty companies are obviously fantastic. You chat with the CEO of a royalty company, there's quite frankly nobody more articulate and smarter than, as a group, the royalty CEOs. They're generally, you talk them off camera, it's sort of like, okay, they're often kind of calm, and then they get on camera and it's just like, wow, where'd that come from? But absolutely, I think that is an appropriate strategy, because we're not at that stage of the cycle yet where we have the generalists pouring in that want to take a bet on those dormant developers that I was speaking of. We're still at the stage where, and this is a great thing too about using AI, and I'm not saying it's perfect, but you can go on there and like give a bunch of price inputs, and I say, what kind of cash flow is Agnico Eagle going to be generating? Take your time, and you can just sort of like have a conversation with it to try to come to some of your own ideas of, if gold stays at $5,000 and silver stays at $75, etc. What kind of cash flow are we looking at? What kind of EBITDA are we looking at? And then historically, if we look at the multiples, what do these companies trade at? And I think that from a risk reward standpoint, you're just not going to beat owning those top tier companies right now. Although I am a big proponent for the riskier side of the curve right now, in my opinion, your best bet is the types of names you just mentioned.
Yeah. And I think that, because for me, I do have some juniors and such, but the majority of my capital is in like Wheaton, Franco and some of the bigger market caps in the space. Obviously it's more beta, and sometimes I'm trading some of the alpha for the beta. So like, when we've had these times where the market has went absolutely bonkers or just very hot, we had this happen, last September. We had a huge run up, and in October we had a sell off and such. So then I was taking some money off the table, parking it into some of the bigger names. Same thing here recently in January and such as well. And so there are times where, like me, I actually take some of the alpha off the table, like where it's like, okay, this is getting way overheated, and let me go ahead and park this into a Wheaton or such. And obviously there are, like, right now we're in very volatile times, with everything going on in Iran and such. I mean, even recently the miners sold off significantly. I mean, Wheaton sold off down to like $107 overnight, and me having access to a Robinhood, I was able to purchase some shares overnight. So that was like one of the, I used to hate Robinhood, by the way, but then like I started seeing like, okay, they're actually making some improvements and such. I actually like them now. But yeah, go ahead.
Can I add something to that? And that is absolutely, I think that like right now, that is 100% where you're going to find the best alpha, those sort of tier one names and the tier two names that look like great acquisition targets. Like, for example, I'll throw a name out there. IM Gold, I think, is screaming for Agnico Eagle to buy them out, just because Agnico Eagle owns pretty much, I forget, it's like half of the top 10 gold mines in Canada, and IM Gold has like 2 or 3 of the other ones. So that to me is a second tier name that I think is a must own. But the thing that I'd say is that when we talk about these sort of juniors and we move down the risk curve, I wouldn't put too many, like I said, unless you're like in a position like Jeff, where you're actually able to go in, raise money, and exert control over the management team to have some sort of say into what's happening, because you just don't know. You got to be really careful. So I wouldn't put too much of your portfolio on any of those bets. And even when they feel really good, and I've been fortunate enough to experience a few like 10, 20 baggers over the last couple of years, you still don't know. Like one name that we were in at 8 cents, Antimony Resources, that today, last time I checked, was like $1.40 or something like that. I looked at it and I thought, this is one of the most, this is one of the top antimony projects in the world, or at least in North America, and it's trading at like, a $5 million market cap or something like that. But you don't know. Like you just you don't know what's going to happen there. So like, would the management team be able to go and raise the capital? They went and they found a New York group who funded them, and they helped take it there. But you don't know, and that's and I basically do this for a living now. And even when I look at the really good bets that I really, really like, you just don't know. For every great bet you take, you're lucky if 1 out of 3 of them actually materializes.
Yeah. So let's talk a little bit about before we wrap up, and I want you to plug the audience with all of your what you're up to. Profit taking. So this is like it's like an art within itself. It's like an art within the art of investing, right? Like I mentioned, we had 2 significant run-ups in the past, 6 months, 7 months. We had one leading into the end of September. We had one going into the end of January and such. And we've had some volatility since then. But, for, let's say, you're in a company at 6 cents, it goes to $1.40. Are you like 'cause I think Don Durrett, like he's been buying these stocks since like the prior bull market. And he's just been holding. I don't even know if he sold a stock or what. Like, maybe he has, but it seems like he just holds on to these companies. He's like, he's firm that these companies are going to go higher as long as the price of gold goes higher, and his macro view reinforces that. And he does a lot of other due diligence too. So I'm not trying to just simplify Don Durrett, but are you typically taking off your initial investment at some point? Are you taking a little bit more off the table when you get these huge gains? Like, how are you working with profit taking?
I try to always, when I'm in a winner, I always try to take some chips off the table as we move up. That's just smart. I was talking to one of the top bankers at Canaccord, and he said to me, always be selling. I think that's because I've been in stocks that have gone 10, 20x, and I've round tripped it before. And when you've made let's just say that you make a $10,000 bet and you see it go to $200,000, or some people $100,000 bet and you see it go to $2 million, and you're hearing all this chatter on the boards and from people that we're just getting started, and then the next thing you know, it's one of those staircase on the way up, elevator on the way down scenarios where you don't even have an opportunity, like you don't get a chance to think, and suddenly it's completely gone. So I'd encourage anybody who's got a winner to take chips off the table as you go up, because there's nothing worse than that feeling where you had a big winner and you just watched it all disappear, and that has happened to me many times. But I'm going to add this, and I know that I've sort of said that, like, and I'm not trying to talk down the macro. I love the macro too. Yeah, we talk about the macro a lot. It's just, we all kind of know, we if you're in the space, you probably think that gold and silver are going up. I do have one actionable piece of information that I believe. I'm not telling anybody how to invest. I think that you're going to want to get yourself into a lot of cash by August. The reason I say that is that the midterm elections could prove to be a pretty ugly period for the stock market. If Trump loses both the House and Senate, and he's effectively a lame duck president for 2 years, there might not be a whole lot that gets done. And I don't know how that is going to play out for precious metals. So it's something that concerns me a lot, because I've got a lot of big winners on the table, and it's something that I think a lot about is at what point do you kind of want to start to worry about that? And I think that we're going to hit a point there where these things go in cycles. They just do. And in my opinion, as we hit the summer, if you've got a lot of chips on the table, I suggest, at least in my case, take some of them off, because the midterm elections could prove to be a bit of cold water on what's been a pretty good bull market.
Yeah, for sure. I mean, obviously we have, you have physics, right? And you're like, okay, these companies, like copper, for example, no new discoveries, and very little discoveries in the past 10 years or whatnot. And you're like, okay, at some point this has to revert to mean. And so it comes down to your time horizon. That's one piece of it, but if you're sitting on some gains, right, and you're like, and there's a lot of uncertainty coming down the line. I mean, even right now with the Strait of Hormuz being, still effectively shut, and then there's a blockade and all of that, right? All this has impacts, energy costs, skyrocketing and such, and, and it has a lot of impacts. And so like, there's a lot of uncertainty right now. And so, for me, like I've been building more of a cash position myself. And so, yeah, I totally agree with that.
Can I add one thing to that?
Yeah, go ahead.
The last time that it got really bad for the juniors, and I'm trying not to be too much of a negative Nancy here, but the last time it got really bad was after Russia walked into Ukraine and oil prices spiked up, and that created a whole bunch of inflation, and then interest rates went up. That proved to be a pretty rough couple of years for the juniors after that happened. And we may be walking into a similar event as well. So to your point, it's probably not a terrible thing to be starting to think about moving towards cash during such an uncertain period.
Yeah, for sure. Well, Steve, appreciate you coming on the show and everything. Very thoughtful conversation. I enjoyed this conversation. So where can people connect with you, ask you questions? Do you have like a service where you all give out your stock picks or anything of that nature? Like what are you all doing?
So I'm on Twitter under Small Cap Steve. We got a YouTube channel, The Deep Dive. We got a website, thedeepdive.ca. We're actually crushing it for views right now. I apparently, I don't know what's happened, but we cover a lot of macro on our website, The Deep Dive, and then we cover mining stocks. You'll see a fair bit of coverage of whatever's happening in the space on our website. But if anybody wants to reach out to me, they can reach out to me on LinkedIn at Steve Hyland or on Twitter at Small Cap Steve. And I'm always happy to chat with anybody about the space that is trying to learn. And just for any young people out there that are trying to figure out how to get into the space and they're kind of lost. That's one thing that I'm always happy to help people out with, because I was once in a similar position myself, and I know that there's a lot of people out there that watch this content and they're trying to figure out how to get involved, and I'm always open to anybody who reaches out.
Yeah, for sure. You all have the information. Be sure to go connect with Steve. Deep Dive on YouTube, as well as following him on X and on LinkedIn. Please hit the subscribe button if you haven't subscribed yet. Love to have your support as we're on the road to 100,000 subscribers. Thank you, Steve, for coming on the show. I mean, you've been to VRIC and such, but I think this is your first time on VRIC Media, so thank you for coming on the show.
Thanks, Daryl.